Here's today's Money Metals Minute, brought to you by MoneyMetals.com. A better than expected jobs report Friday dealt a blow to precious metals. That share prices rallied. For the moment, markets are moving higher regardless of what's expected from the Fed Reserve. There's been some recent disclosures revealing central banks, including Switzerland's, are buying U.S. shares aggressively. This week, investors get the monthly reports on producer prices and retail sales. Now, here's a special report from Mike Gleason of Money Metals Exchange.
Where precious metals prices are headed this coming week or next month is really anyone's guess. The near-term outlook will always have more to do with the latest news events, technical levels, and momentum gauges than with fundamentals. But the long-term trend will ultimately be determined by the fundamental drivers of supply and demand. One of the greatest fundamental underpinnings for a gold and silver bull market is the fact that most all other perceived forms of money around the world are being debased. The latest central bank to make its currency less attractive is the Bank of England. This past Thursday, England's central bank cut its benchmark interest rate for the first time in more than 7 years. Policymakers pushed the lending rate down to a minuscule 0.25%, the lowest in the 322-year history of the Bank of England. They also rolled out new bond buying programs they hope will stimulate a weak economy and counter post-Brexit selling of British financial assets. Britain joins other countries that have entered uncharted territory in terms of monetary policy. Many of England's EU neighbors already have negative interest rate policies in place. Britain could well follow suit before the end of the year. In an era of globalization and coordination among world central banks, the Bank of England's decision to cut makes it all the harder for the U.S. Federal Reserve to hike. The recent GDP disappointment, as well as political considerations surrounding the upcoming election, already meant the Fed likely would do nothing until December. Now the odds are increasing that the Fed's next move, whenever it comes, could actually be to cut rates, or perhaps announce a new emergency asset purchase campaign. Central banks are no longer limited to just buying government bonds. Central banks are acting like giant hedge funds now, playing with unlimited quantities of currency created out of nothing. Many have ventured into corporate debt, stocks, even real estate and tangible assets. Some are following the lead of Russia and China in expanding their gold reserves. But by and large, they are amassing even more paper on their balance sheets. Buying up trillions of dollars in bonds and driving down interest rates to levels previously thought impossible hasn't done much to help central banks achieve their stated goal of stimulating economic growth. They haven't even been able to raise official inflation rates as the side effect of their unprecedented efforts. They have instead created a gigantic bubble in the global bond markets that makes all previous stock market bubbles look small by comparison. Stock investors never got crazy enough to go for stocks that sport a negative dividend yield. The insanity now gripping the bond markets is enough to drive the world's most famous bond fund manager out of his own asset class. Bill Gross of Janus Capital said in his latest commentary that he doesn't like bonds or stocks as investments anymore. He is shifting his focus to tangible assets, including gold. It's a radical change in thinking for someone who has built a lucrative career on financial assets. Unfortunately, most investors are still choosing their investments and making their retirement plans based on assumptions that haven't changed with the new low-yield realities. Bonds are an asset class that has worked for 35 years. The belief that bonds are steady, safe, and gain value over time is deeply entrenched among the investing public and most financial advisors. The risk that their assumptions will turn out to be wrong, though, is very real. If at some point the bond markets break, those who are diversified into physical precious metals will have some protection against the fallout. Time to acquire gold and silver as insurance is before the next financial crisis makes headlines, not after.
And that was Mike Gleason at MoneyMetals.com. Live prices at MoneyMetals.com. So gold currently trading at $1,334.85 per ounce. Silver, $19.79.